Good morning. Welcome to a Tuesday edition of Who Charted. I am Dan Russo, Co-CIO here at Potomac, and we're coming to you on a Tuesday as U.S. markets were closed yesterday for the President's Day holiday. It was also Valentine's Day over the weekend, so I hope anybody who celebrated Valentine's Day had a really good time with somebody who means a lot to them, and hopefully you ate some good chocolate. We're going to dive right in shortly. I think the weight of the evidence is an interesting way of looking at the market right now because I think there's two ways of looking at it. One way is bullish and another way could be construed as bearish, as there is potentially too much weight sitting on top of the market right now. We'll get into all of that in just a moment. I also want to highlight the fact that we are going to touch on something that I think could be one of the dumbest things that I have ever seen in markets or have seen in a long time. We'll touch on that in just a moment. But before we do, let's go to the charts of the S&P 500 and the NASDAQ 100 starting. Not much has changed, right? We're still in these consolidations. Strong rallies off of the April lows, but kind of sideways to slightly negative activity here since the end of October, bouncing from one holiday to the next. So call it from Halloween to Valentine's Day, sideways activity for the major averages. Now, these consolidations play out above the rising 60-week moving averages. So if you're just looking at the charts of the two major indices, right, everybody in the U.S. pays attention to the S&P 500 and to the NASDAQ 100. I know some people like to say the Dow is important, but the Dow is 30 stocks, price-weighted. It's not super important. These two indices are the ones that most people are benched to. These two indices are the ones that most people follow, and they're just consolidating, right? Now, we know the problem with both of these indices, however, and we will touch on that in a little while. The problem is that they are cap-weighted, right? We'll touch on what that means in a couple of slides. But from a trend perspective, consolidation above the rising 60-week moving averages is hard to argue that these charts themselves are bearish, right? And then if we look at market breadth, as we like to do, the second leg of the stool, how healthy is the trend? The NYSE advanced decline line with its 43-week moving average, NYSE advanced decline line, another new high. All right, that's in and of itself bullish. And a lot of times this leads, right? Remember, it is a market of stocks, not a stock market, right? So when we see individual stocks breaking out ahead of the market, that's usually a good sign for the market in general. I'm stressing usually here this time around. It's slightly nuanced, right? More stocks going up than going down, clearly bullish on the surface. However, let's discuss the makeup of the markets, right? The two main markets that everybody pays attention to, the S&P 500 and the NASDAQ 100, are cap-weighted indices. That means the largest stocks are the most important by market cap. The Mag 7. All right, let's just use the Mag 7 as our proxy for the most important stocks, for the largest stocks in the market. Now, you've seen this chart before, and what I have said repeatedly is the market can hold up if these are going sideways. If these are going sideways, the AD line is breaking out, right? At the end, we've seen in the past, we've looked at the S&P 500 equal weight breaking to new highs, right? That is all a sign of underlying participation. However, the weight of the market, right? The weight of the evidence, the weight of the market can sometimes be too much. These are the heaviest stocks in the market. And if they break down, I don't really care what the other 493 are doing, right? If these are going sideways, like they've been doing since September, October, that to me is okay. The 50-day moving average in yellow up here has kind of moved into a sideways trajectory. That's okay. The 200-day moving average is still rising, right? The long-term trend is still up. However, if we see a decisive breakdown and a change in the 200-day moving average, I don't care what the other stocks are doing. It is going to be hard for the indices to do well, okay? Potentially we're getting into an environment where if stock picking is your thing, that becomes, something that you could take advantage of, right? But if you're a buy and hold investor and you're just long the S&P 500 through an ETF or an index fund, or you're long the NASDAQ 100 through an ETF or an index fund, if this breaks down in a meaningful way, the other 493 stocks or the other 93 stocks probably are not going to help you. So you want to pay attention to this closely. So the weight of the evidence from a market's perspective is bullish. However, the weight of the market could start to be a factor, okay? This is something we want to pay attention to. At the same time, we also want to understand market psychology. Now, I want you to take a look at this chart because it still looks great, right? This is the Dow Jones Transportation Average trading well above that 27-week moving average. But look at this candle here, okay? That candle there is a bearish candle, right, with a huge volatility range. And what caused that huge volatility range, right? What caused the low to go down here? Well, if we looked at a daily chart, you'd see that it was on Thursday. And I'm going to put my little pen down here for a second and read something to you. Now, these were quoted in the Financial Times from other publications. All right. According to the Wall Street Journal, the sell-off in transportation stocks appeared to be sparked by a press release from a Florida-based company called Algorithm Holdings, which claimed its semi-cab unit boosted customer freight volumes by 300% without a corresponding increase in operational headcount. Bloomberg piled on and said logistics stocks plunged on Thursday because of this algorithm. I want you to understand what Bloomberg also said. Algorithm is a $6 million former karaoke company. You heard that correct. Let that sink in. We have gotten to the point in the AI story, right? Investors are so shell-shocked by what has happened in the software space that any threat to AI has investors' finger on the sell button, taking down real companies, real businesses, J.B. Hunt, right? FedEx and the like. Real companies, real transportation companies are seeing value deteriorate because a $6 million former karaoke company claims to have an AI product. I don't know if it's true, but that gives you a sense for market psychology at the moment, where investors are willing to shoot first, ask questions later, right? We look at this chart, it's still fine, but understand the driving psychology of the market right now, and then couple that with the fact that you saw this chart 2 weeks ago, you're seeing it again. These are consumer staple stocks, okay? Consumer staples companies are the companies that sell the products that you need. Not the products you want, the products you need. You lose your job, you are still going to buy soap. You're probably still going to buy toilet paper, right? All of these things you're still going to buy. Those are consumer staples. Consumer staples have broken to an all-time high here out of a large consolidation, and they have turned the corner relative to the S&P 500. So if we kind of think about what that means, right? We have this breakout here, and we've turned the corner here. Investors are actually starting to allocate to safe havens within the equity market. So something to keep an eye on. The weight of the market could start to overwhelm the weight of the evidence. I'm not saying it's going to happen. I'm saying that's something you need to pay attention to. So I am going to leave it there for today. I hope everybody has a great holiday shortened week, and we will come back to you next Monday.